wait, I'll put it on hold. All right, guys. Without further ado, welcome to today's this edition right now of Volatility Windows and Pivots. Welcome to this webinar of Volatility Windows and Pivots. So we're going to talk about. I'm going to share with you volatility windows, which are based off of the an intraday trading session, as well as 6-month pivots and volatility windows, and how we use them, and how they set the tone, how they can kind of set the tone for the day and create different biases. In this webinar, we'll review market feel, use, and guidance of volatility windows combined with pivot levels. So two type of volatility windows we look at: intraday volatility windows, which is used for an intraday basis based off of each session. So today, yesterday, every day has its own volatility windows, and 6-month volatility windows, which is based off of the first half of the year and the second half of the year. And these are used for longer term macro bias and swing trades. And we're also going to apply the pivots, intraday pivots. Again, same thing on an intraday basis. And an intraday pivot is based off of the prior session. And 3-day pivots. 3-day pivots are based off of the last 3 days. So rolling pivot, and it helps show momentum and what the trend is, whether it's a bullish trend or a negative trend. We'll also see kind of apply it how what's happening today. But for now, we want to kind of learn and review the pivots of volatility windows. And volatility windows are based off of the pit open. So we use the first 10 minutes. Every market has different opening range. On the S&P, we use the first 10 minutes. On gold and silver, we use the first 20 minutes. But the first 10 minutes is considered the opening range. And volatility windows, they offer a level for the market to trade within, create a bias for expansion, and or set up traps. Half the time of the opening range is needed to establish a bias. So that futures, they're almost 24/7. So they're trading around the clock, maybe an hour or two break, and then it begins again. So the volatility windows gives us an area that the market can trade within based off of the cash session. And half of the time, so the opening range is 10 minutes. So in order to establish a bullish or bearish bias, the market needs to spend at least half of the time, half of its opening range, 5 minutes to establish whether it's a bull or a bear bias. So a 5-minute hold above the upper vol window establishes a bullish bias. A 5-minute hold below the lower volatility window establishes a bearish bias. And once a bias is established, market can only reverse the bias. It cannot have another bias. So for example, today is a bearish bias on a day. It can no longer have a bullish bias on a day. The only thing that can take place is a reversal. The pivot and pivot ranges, the intraday is based off of the previous pit and trading session, help to identify support and resistance on an intraday basis. And I like to plot these on the intraday time frames, 5-10 minute, using dash lines, and this gives us a reference point where we can look for support and resistance, kind of like a zone. And the 3-day pits, we plot these on a longer time frame, 30, 60, 90 minutes, and they're based off of the last 3 trading days, and they help to identify the rolling support and trend. The reason why we use a range, because I'm sure most of you are familiar with pivots, and you know how they're calculated. Take high low close divided by 3. That's how you get the pivot. So that's the pivot. The reason why we use a range around the pivot is because it helps identify a cushion. There's no solid number that the market can hold. You can have support at, for example, at 45, and the market can run, slice below 45 and recover it right back up. So a range gives us a cushion around the pivot, and the width of the range is very important, because the tighter the pivot is, the more it shows indecisiveness, and that could be a sign of caution that we could see range expansion. And we'll take a look at those too. So a wide range, it's a volatile previous session, opportunity to see consolidation. A narrow pivot range indicates it was an indecisive prior session, and allows opportunities to break out of a previous range. So think of it like a rubber band. The more you stretch it, that's how the pivots become. They become more and more narrow. And we have a narrow pivot. It's like stretching out the rubber band, and that gives opportunity for the snapback and for a break of the previous trading session. So when the market holds above the upper volatility window for half of the opening range, a bullish bias is established. Pressures to the upside and pullbacks are to be defended. So if you have a bullish bias on a day, that gives you the flow and the momentum on a day, and you want to be looking at buying pullbacks. And you know, if you're selling into that, you're selling against, you're being contrarian, you're selling against that bullish bias. Those can work very well when you're looking for traps, but most of the time, you want to go with the momentum or with the flow. And if you have a bullish bias, then you know, and if you're selling it, you're fading that. And the same thing, if the market holds below its lower volatility window, a bearish bias is established, pressures to the downside, and rallies are to be sold. Today we have a strong bear bias. We're seeing all the rallies get sold into. When the bias is established, buyers and sellers are forced to defend retracements into the window and into the opening range. And the last line is the reversal window. So think of it like a race or a start. So the market starts at the opening range. Today we broke below the volatility window. It establishes the bearish bias. So the sellers and the bears are in control. If the market pushes back to that opening range, it's key for the sellers to defend, to retain control. And it can take out the opening high, which is where the reversal window is, just to run the stops, and it still can be technically a sell. But in order to reverse its bearish bias, there needs to be a sign of demand with at least, again, 5 minutes above the reversal window to reverse the bearish bias. So it's not just a step run, it's based off of time. How much time does the market spend? So a hold through the reversal window for half of the opening range reverses the intraday bias, leaving longs and shorts trapped and giving way to expand in the opposite direction. From what I found, you'll see that the times when the market moves the most is when it creates those reversals, because more people are caught on the wrong side, and those buyers or sellers are used to expand the market in the opposite direction. Sometimes the bias is established to lure in traders in a trap and get traders on the wrong side to use for a reversal and to fuel the market into the opposite direction. And these are the different type of volatility windows. We'll view some of them today. And you can have a constrained day where the market is just trading inside of the windows. This is a tight trading day. A bullish expansion where you have a break through the upper volatility window, establishes a bullish bias, and pullbacks are defended. It expands into the close. A bull reversal where it sets a bullish bias just enough to lure in the buyers, and the buyers fail to hold, falls below the window. Those buyers are on the hook, and you have a move below the reversal window where it reverses that bias and it expands to the downside. Confused day, these are very rare. They do happen once in a while, but very rare. Probably see about one every couple of months is when you have a bullish bias that's reversed and it goes back into its bullish direction. So you don't see those happen too often. A bearish bias expansion when you break below the vol window, establish bearish bias, and expand down, what we're seeing today. And a bear reversal is when it establishes a bearish bias, gets everyone short, and it reverses that, and those shorts get trapped. So this is an example of a bullish bias expansion. You can see I always highlight the first 10 minutes as the opening range, but these dotted lines again are where I plug in or where the pivots are, and that shows me where the resistance or support is. So you can see on the open, the market opens. Once the first 10 minutes is completed, it gives us this volatility window and one right below. In this case, the market squeezed through its upper volatility window and it held above to establish a bullish bias. So it's showing its hand. The first impulse move was to the upside. It broke through the upper window. It established a bullish bias. Now, with a bullish bias, buyers have to defend pullbacks. So if sellers wanted to sell into, they have buyers now. because this creates bids on the downside. So we established a bullish bias here by holding above this window for 5 minutes, makes a new high, and then we trade back down. Like as we talked about, when it's a bullish bias, it's luring in buyers above this window, which is, in this case, it's about 3008. We'll say that. So it's luring buyers above 3008. At the same time, that volatility window is now support for the long side to defend all the way down to the opening range or the opening high. And then the last level is the reversal window. So this is technically a buy all the way down to its reversal window right here. And in order to reverse this bias, there needs to be a 5-minute hold below this below the reversal window. So in other words, technically a buy all the way down to this, and it can run the stops below the opening low and recover. But the question is there enough supply that's trapped that the market is unable to recover and it holds below the opening low for half of the opening range? So 5 minutes is needed to confirm reversal. In this case, we had the market establish a bullish bias. We had a pullback down in an attempt to test the opening high. So this was the start. From the start, we move up, comes back to the starting point. Buyers defend that. They retain control. They keep the pressure to the upside, back above the upper volatility window, and we got the expansion into the close. And anyone who's short below 3008 is either forced to cover or being squeezed to the upside. And that's a close on the highs into the end of the day. So that's a strong bullish bias expansion. Flip side of that is a bearish bias expansion. And you can see in this case, pivots was right here. So this was in the overnight, the market tried to overcome the pivots, falls below, going into the open. And on the open, we rally into the pivots, market fails, finds resistance. And what happens is we slide below the lower volatility window. You can see we held below that for 5 minutes, establishing a bearish bias. So all rallies are to be sold. And we had an initial break into 92, followed by the bounce into the reversal window, into the volatility window. Remember we said if it's a bearish bias on a day, like in this case, rallies into that reversal or that volatility window here is resistance. That's the first level of resistance, followed by the open up to the reversal window. So if I'm trading this or if I'm watching this and we have a bearish bias, then I know that the pressure is to the downside. So I want to look to sell rallies. If I'm buying the market, then I'm going against that. And in order, if I want to look for a long, at least I would want to see the market overcome the volatility window to try to trap the shorts below the window. In order to trap the shorts, you got to recover that lower volatility window. But you can see in this case, and also it keeps me away from having to chase the market down, or it kind of keeps you from having to chase after it. So you can see the initial move leg was from 30.10 down to 29.94. So instead of selling into that weakness, you know that the bias for the day is bearish and you want to try to sell rallies. Okay, you want to look for the rallies and look to see where they stall and sell into those. So the lower volatility window up to the opening range. Now the way we trade these is we use, we're using the levels, but we're also using tighter stops. Especially day traders, most of the time you're using tight stops, 3 to 4 points, and you're not trying to risk 10 handles. But the way that the funds trade the volatility windows is they go into flow. If they're selling a break of lower volatility window, they're selling rallies into the open, they're selling rallies into the reversal window, and for them to be stopped out, they use a time stop. So 5 minutes above the opening high, which is where the reversal window is needed to show strength and demand that it's not just a stop run, that the market can actually hold above its opening high. And when that takes place, then they cover their positions. And you can see that can be a wide stop. So if you're selling, let's say 3,000 and the reversal window is at 30.10, that's a 10 handle stop. It's usually a wide stop for for day trading or for the day traders if you're not using tight stops. But that's where the market has to overcome to reverse its negative trend on day. It's kind of like keeping it simple or common sense. Think of it where the market opened, it breaks down, and the window gives us where it has to break to establish a bias. So it broke its bottom window, it establishes a bearish bias. What does it have to do to recover? Is it has to take out its opening high, and not just run the stop, but hold for the 5 minutes, and that's what gives us the confirmation that it's a reversal. But you can see in this case, same thing. You have a bearish bias established below the lower volatility window, rallies back to the volatility window. The buyers fail to overcome. Obviously, the sellers are defending that. A little bit of a chop and a retest. And then as long as the market is below that vol window, the sellers are in control. And what do we get into the end of the day? We got the sellers expanding the market down into the close. And then you can see where the next day, where the pivots line up between right about 89 to 97. So for the next day, those pivots turn into overhead resistance. Here's a bullish bias reversal. And this is the case when you can see the intraday pivots were very tight here, less than the handle wide. And when the pivots are tight, for me, that's a sign of caution because it tells me that the previous day, the previous session was indecisive. It could have been the market rallied and it pulled back and it kind of came right back to its open. It didn't really have a strong day and it created an indecisive day. So it tightens up those pivots, like stretched out rubber band, and that creates caution, which can give way for an expansion of the previous range. So in this case, you can see the market, this is where we opened. We broke through the upper volatility window, establishes bullish bias, and what does it do? It lures in buyers above that volatility window, but the buyers fail to get past the pivots and they fail to take out the overnight highs, and we got a break lower below the reversal window. So it could have been whatever may have been a news event, whatever, similar to today. Breaks below that reversal window, it holds below that 5 minutes, so it takes out its opening low. That reverses the intraday bullish bias. So everyone who bought the market from the open and through the upper volatility window are now on the wrong side, and they have to liquidate their position. So as long as the market is below that reversal window, those buyers are on the wrong side, and they become used as fuel to expand the market in the opposite direction. You can see this reversal window was about 29.04, and it traded all the way down to 28.40, 28.34 low of the day. So this was a big move, about 70 points from the volatility window, or from that reversal window here, and it shows you how the market can move in the opposite, how strong the market can move in the opposite direction when the bias is reversed, because everyone is caught on the wrong side and they're used as fuel. And as well, you have a very tight pivot, which gives a sign of caution that you can see the range expanded. So very tight pivots, establish the bullish bias, the market falls below that vol window, so all the longs above 29.10 got trapped. They failed to hold that reversal window. It reverses the bullish bias, and if it reverses the bullish bias, then I won't be trying to buy it down here because we know that the buyers failed on the day and that it's a reversal bias. Pressure is to the downside. So it's important to know where the 3-day pivots are too, because it can tell us if the pivots were above, then the trend is down. Even though the intraday bias was bullish, the 3-day pivots was above and they provided overhead resistance. So this was a bullish bias reversal. This is a bearish bias reversal. So in this case, we can see the market open right here. We fall down into the lower volatility window, and you can see here, even though it's a wick on this 10-minute time frame, it held below that for 5 minutes, establishing the bearish bias, luring in shorts and maybe stopping out longs. But notice the sellers failed to expand below that reversal window, right? So you can see these shorts, they failed down there. They failed to take control. There was a bearish bias, which lured in shorts, but the sellers failed to expand down. So there wasn't any commitment by sellers to expand the market down. What was the reaction? We had a move through. Buyers step up. They overcome the opening high through the reversal window, hold above that for 5 minutes, reverses the intraday bearish bias, and now all the shorts on the day are on the wrong side and they're trapped. And when you have a reversal bias on a bearish bias, then you can look to buy pullbacks because the sellers fail to expand the market down. So any retest of the low is an opportunity to defend that low. And in this case, you have the bearish bias here where the sellers dropped the ball. They got squeezed, so the shorts were used to fill that move through the reversal window, holds above that to reverse the bearish bias. Then instead of expanding, again, you have a reversal bias, but it doesn't mean you buy above that window. Maybe you want to see if it can hold that window, but if it doesn't, as this case, it falls below and it turns into resistance, then you want to look at a retest of the lows of the day here. And that would be your opportunity to defend the low of the day, and your stop is below 32.75, which is the low of the day. If it takes out the low of the day, it does a bearish bias, reverses bearish bias, and continues to make a new low on a day, that's considered a confused day. And again, those are rare to see. It's not impossible, but they're not as likely because the seller's already shown that they failed to make new lows on a day or expand it down. We had a reversal bias, so the retest gives you the opportunity to defend that. And you can see the market came all the way down to retest the lows. And also, think of it, if you're short the market below the opening range and the bias was reversed, when the market comes down to where you're short at, you're probably looking to get out. If not, like they say, fear turns to greed at break even. So either, I like to call it the get out of jail free card. So if you're short 36, we trade all the way to 44. When the market comes back down to 36, that's your get out of jail card. The market is giving you an out. And by giving you an out, all the shorts who are trapped, they're looking to cover their positions, and that creates that demand. That creates the support because you have shorts that are trying to buy back their positions, and that creates that opportunity to buy that and that support, and use the low of the day as your stop. So the shorts got their chance to get out here, also gave buyers a chance to defend the low of the day. And if the market does not make new lows on the day, what do shorts have to do, especially the day traders? They have to cover into the close, right? And we can see this was probably, again, news. We had news there, but in any case, a big squeeze all the way up to 56 from 36. The shorts, any shorts that didn't cover their positions into 36 were forced to be squeezed on the move above the high of the day. Once it gets back above that reversal window, all the shorts on the day are trapped below, and they're forced to be squeezed or cover at higher prices, because this was their chance when the market came down on that retest of 36. So bearish bias is reversed. And if you have a bearish bias and maybe you sold this open, you were stopped as the market made a new high on the day. So that idea for the day is wrong. The bearish side is wrong. And you have a reversal bias. You want to look to buy pullbacks into testing the low of the day, because you know that the flow or that the bias for the day is a reversal. Here's another bearish bias reversal. And again, especially when you have a strong uptrend and maybe a strong bull trend where the market has been trending higher, sometimes the market will break its lower volatility window just to shake out buyers, lure in sellers, and when the sellers fail to expand, they get hooked, and that creates fuel to expand it up in the bigger picture. So in this case, you can see very similar to what we had here, but in this case, the market came all the way down to try to test that lower volatility window. fell a little bit short from testing that. But look at in the next scenario where that reversal window turned into support. So you have the overnight fails into the pivots. We had a lower open. So this was a gap down. The market continues its weakness after the open where everyone pukes. They sell into that open. That gives way to break the lower volatility window. We established a bearish bias and the sellers failed to hold below that window. And what do we get is a move through. You can see first test of that reversal window. They tried to hold that, a little bit of a dip, and then right back through. Once we hold above that, it reverses the intraday bearish bias. Everyone who shorted the market on that day is caught on the wrong side. And over here, we had a test of the pivot, which kept the lid on the first run into it. And we had a pull back down. That reversal window turned into our first level of support. And again, everyone who's short on the session here is on the wrong side. And that's what turns that level into a defense or into support, is because there is supply below that that's on the hook. And by holding, it leaves them trapped. And you can see as it held its reversal window here and not coming back down, it left the shorts trapped in the day, rallying back up. It forces those shorts to cover into the close. And we're right back to the highs of the day. So what I like to do, we'll take a look at some examples from last week. But if you have a gap down where most of the selling was done in the overnight, then instead of selling the open and chasing the gap down, you can look to be a contrarian. But first, you want to wait to see what the reaction is with the volatility windows. So you have a gap down, you wait to see, does the market test this vol window and bounce off of it, or does it establish a bearish bias, lure in the late sellers, and let's see what the late sellers do. Can they continue trending it down, or do they get hooked and the market turns, and now you have a gap down that just lured in shorts, probably shook out buyers on the stop run below the vol window, and then that sets the trap. The reversal is the confirmation where once you have the move through the reversal window, it confirms that the sellers were wrong on the day. You want to look at buying pullbacks or buying weakness, and at least not fading a bearish reversal because the sellers dropped the ball. Here's what happened last week, and I don't know if we want. So we can see on this was 25th. So I think this was last Monday. Yeah, last Wednesday and then last Tuesday. So last Tuesday, this was the move last Tuesday. We had the market fall into the lower volatility window, catches the defensive bounce. The buyers try to hold that, but they failed. You can see here they failed to overcome the open. We fall below the vol window, holds below that, establishes a bearish bias, and we get the liquidation or expansion down into the close. And if you remember, this was last week when the market was fighting to hold that 85. This was 85s. And once we lost 85s, it went after the December 10th low, which was 57. We made a low of 58.50, and we had a tweet by President Trump, which caused a squeeze and right back to retest the low and settled. Now, the next day, you can see where the pivots are lined up right here. And what I'll show you on this day here is I like to look at, it's important to look at where the previous close was. Very similar to today. And we'll look at today in a little bit. But this September 24th, last Tuesday, was when, similar to what we had today, a gap up, the market opened higher. So you can see last Monday, the market opened below Friday's close. So we had a gap down. The sellers failed to take control, so it turned into a bear trap, and we rallied into the close. On Tuesday, the market opened above its prior close, so it set up the buyers with the jump ball, the higher open, and it lured in buyers, and they failed to hold above the prior close, and we had the move down, and that is what also kind of expanded it to the downside, is because it had the higher open, gets everybody long, and expands to the downside. Kind of like what we have happening today. You can see here we have a big gap up, lures in buyers, and they fell. So on an intraday basis, if we look at here, we got the move down. So the next day, we closed on the lows. The next day, pivots are here as resistance. And look what happened. We had a new low in Globex, followed by a bounce. And see what happened last Wednesday is we opened with a gap, a neutral open, sold below that lower volatility window, established the bearish bias. So it lured in shorts below 29.65. And you can see it clips the overnight low. So it runs the stops below the overnight low, stops out the buyers, and then it gets back above the volatility window. So when it gets back above that volatility window, what happens to all the sellers below that window? They're caught on the wrong side, right? And you can see on the cash chart, this is that situation right here, is the market took out the prior session low on the first hour, failed to expand, and recovered right back above. And you can see in the next hour, it squeezed up to take out the opening high. And that's here. Let me see if we can. Okay, so this is a stop run below the overnight low. We get through the vol window, shorts on there on the wrong side. And you can see right here where this blue arrow is where the shorts, the sellers, they failed to expand it, take back control below that lower volatility window. And if you follow my Twitter, I posted that where it's a potential bear trap. And if you're contrarian, or if you're stalking along, then that's what you want to look for, is to see if the sellers can expand below that vol window. If they can't, then that's an opportunity to buy it down here using the low of the day as the exit. You can probably use a tighter stop because you don't want to see it get back below this, but you can get caught up in the noise because as long as it doesn't take out the low of the day, it can still hold. We got a move into the reversal window, which was 73, right above the opening high. Holds above that, establishes a reversal bias. So reversed the bias on a day. You can see we chopped sideways. So all the shorts on the day are caught on the wrong side. And in this case, you can see it doesn't give sellers a chance to get out. And it forces buyers. Let's say if you bought the open, you got stopped out on the move below the prior day. Now it's holding above the opening high, so it's forcing buyers now to have to buy back where they originally bought before getting stopped. And that's what creates the V bottoms, because the move down stops out the buyers, the move up stops out the shorts, and then that sideways consolidation is where it kind of tries to build a base. It doesn't give buyers opportunity to buy the test of the lows to get back in cheaper, and it also doesn't give sellers the chance to get out. So you have a reversal bias on a day, and you're not going to be looking to fade this here because of that bias. And what I like to do is you take the range, which was from the reversal window to the low of the day, and add that to the top, and that gives me a target of where the market can trade up to. So it was about 75 to 55, that's 20 handles. To expand that range, it gives room up to 95. So you can see we end up closing on the highs because when the shorts, when the bearish bias is reversed, the shorts are caught on the wrong side, and when it doesn't fall back below that reversal window, the shorts don't get a chance to get out, and they're forced to cover into the close. So they push it up into the close to force the day traders to cover, because the time runs out, they're not getting lower prices, so eventually they have to close out their positions into the end of the day. And then you can see the next day in the Globex, we had the market run the stops above the prior high, right into 95, turned out to be the high, right into 95, which completed the range expansion from 75, 20 handles. And we had the market open here, falls into the lower volatility window, catches a defensive bounce, into the open. This is the opening range in blue, right? So the test of that lower volatility window catches a defensive bounce. The buyers are unable to get past the open. You get another move below the lower volatility window, establishes a bearish bias, and it falls right into retesting where the trap from the previous day was set below 64. So you can see this was where the trap was set in the previous day below 64. And even though on last Thursday, the market established a bearish bias, is those sellers got lured in below the volatility window here, but they failed to get past that 64. Once we recover that volatility window, what happens to all these shorts? They're caught on the wrong side, and there's a potential for them to be trapped. And you can see, remember, when it's a bearish bias, rallies to the opening range is key for the sellers to defend, to maintain control. And you can see here, they defended the first rally into the opening range. The opening low was 77.50, made a high of 78. So sellers defended the rally into the open. They get another shot to try to expand below the lower volatility window, and they fail. They run out of selling momentum. They selling exhaust. And you can combine other stuff like looking at footprint or market profile and see if you see sell imbalances in here, because if you do, then you see that the sellers are piling in, but they can't get the market down. Once it gets back above that volatility window, what happens to the shorts below that? They're left trapped, and that gives room to squeeze the market into testing the highs of the day. Now notice in this case, the market squeezed all the way into its reversal window, took out the opening high, but it failed to hold above that. So it failed to reverse the bearish bias, and we closed slightly lower. So on Wednesday, you had a reversal bias that was expanded up. So there was enough shorts that fueled the market in the opposite direction. On Thursday, the market ran into its reversal window, but it failed to expand higher. So most of the shorts got stopped out on the previous day. It's more rare to see multiple reversals in a row. So if you see a reversal on Wednesday, a bearish reversal on a Wednesday, it's going to be harder to reverse that bearish bias on Thursday. And you'll notice that you'll see that because on Wednesday we had shorts on the wrong side that were used to expand it up. On Thursday, it was a little bit harder because the shorts already got stopped out on Wednesday. So you can see on Wednesday, market failed to reverse its bias. And we settled right back in the middle, so the bias on the day stayed bearish. Even though it didn't make new lows on a day, the rallies were getting sold. Except over here, you can see this was when. So how you want to use this is you look at, okay, we established the bearish bias. It recovers that volatility window. You want to look to see the retest. So maybe you're selling that. If you're selling the test of the open, when it comes back below that vol window, it gives you a chance to scale. But when it comes back to your price, you're obviously getting stopped out if you're using break-even stops. Because,
President Trump has put the issue of health care back on the political front
you don't want to see the
burner,
market move
providing
back to your
ammunition
price.
to Democrats and worrying Republicans who think a new battle over Obamacare will hurt their party in next year's elections. Senate Republicans defending 22 seats next year thought they had put Obamacare repeal behind them when they told Trump earlier this year they have no intention of acting on health care overhaul before the election. But Trump threw the issue back at them in an interview with ABC News that aired Sunday, saying his administration will unveil something terrific to overhaul the nation's healthcare system in a month. He argued that action is needed because
the next day, which was
Obamacare
Friday,
has
remember
been a
Friday we
disaster.
had another news event where we had the market flush from 65, from 85 down to 60, right?
Do not worry, sir. I also
So look
fix
at
cars.
Friday's situation. And again, you can see even though the overnight is taken out as running stops above the prior session high, look at what's happening. It's having trouble expanding above that. And
do not worry, sir. I also fix cars.
On Friday, we opened,
at Farmers Insurance,
traded
we
down
know a thing or two
to
because
take
we've seen
out
a thing or
its
two.
lower volatility window, and the pivots are right here. So they're providing a cushion. And we
President
established
Trump
a bearish
declined to endorse
bias
Vice President
by
Mike
holding
Pence.
below that
Should he
vol
make
window.
a White House bid of his
And
own
again,
in 2024?
for me
Trump
at
said
least, is
Friday on Fox
when
News channels
if
Fox
it
and
establishes
Friends
a bearish
that he would
bias
have
like
to
that,
evaluate the field
I
of
know that
candidates, but
the
added that the
momentum
Vice
of the trend is
President
down,
is a, quote, very,
but I also don't want to
outstanding
sell
person.
into that
He said
because
he would
I
give
know
a
that there can
possible
be a
Pence
bounce to test
candidacy,
the open,
quote, strong
and I know if I'm
consideration.
selling it
Pence
here,
has not
if
yet
I'm using a
indicated
tight
his
stop,
plan
it can
for the
be
2024
clipped, it can be
presidential
stopped out
race.
on a
Trump
squeeze
and
back
Pence
to the
are
open,
believed to have a close
even not squeeze back to that window
with the
like
president
it
often
previously
offering public praise
on
for his
Thursday
top
where it tested
lieutenant.
its reversal
Though it was
but failed.
recently reported
But you
that
can
Trump
see,
has
so if
largely
you're selling
ditched
it
his
here
one-on-one
and
meetings
using a
with
type
Pence.
stop, you were stopped out on a retest of the open. And but what using how the windows can help is that if you have a bearish bias on the day, then you know that the bias on the day is bearish and you want to sell rallies. And the rally back to the opening range is key because that's where the move started. It started from the open, slid down, so to move back to the open is where you defend it. And in order to get out, you need to see a move above the opening range. Right? You have to see buyers take control and get it above the opening range. But you can see here, this was a nice short play because
we've seen a thing or two.
there was a bearish bias established here. The market squeezes back to test its open. And since you know the bias on the day is bearish, you're selling that squeeze. So you're looking for the market to stall, and you're looking for sells. You're selling the rally, and you're using the high of the day of this cash session to get out 89.50. So the closer you get to that, the closer you get to the exit, the smaller your stop will be. You can see if you sold it down here at 75, you still made money, but you had to go through a 10-point. You had to take 10 points of heat, and your stop would have to be above the opening high, 89.50, because you know the market has to take out its opening high change to reverse its bearish bias. But
the unemployment rate remained
get the test of the open, at least now your stop is above 90. It's a little bit smaller, so instead of risking 10, you're risking 5. And all you're looking for, at least for me, is if I'm risking 5, I want to see at least 5 in my direction. So if I'm selling 85s, I want to see 80 or a test of that lower volatility window to give me a chance to scale and put my stop at break even because I don't want to see the market get back here. Once it gets back below volatility window, it gives the sellers another chance to expand down, and we had a flush low to low today into a low of 62.50. Now this was news related, so you can never predict when news is going to come out unless if you have insider information. But most of the time you can't predict when news is going to hit the wires, but you can kind of gauge who's caught on the wrong side and what the momentum or bias on the day is.
France and South Korea opened the tournament today at 3 p.m.
So we had a bearish bias already. The tone of the day was set before that news came out.
3 p.m. Eastern.
Bearish bias.
I did. Yeah.
Squeeze to the open. You're selling that. You need to see a move above the opening high. But okay, the news comes out. It makes new lows. That only news helps make things move faster. So that helped the market move from 85 down to 60s fast. And then since it made a new low on the day, you can see the rally back to that volatility window is now resistance or turned into resistance, and it failed to overcome that, leaving any buyers who got in here on the wrong side or trapped. And then bearish bias on the day, what do we get is we got an expansion down into the close.
Turns out it was a swarm of ladybugs.
So look what happens on Sunday.
I don't think it is better known as that, actually. The LA Times
this
reports
was
that the ladybugs were flying between 5,000 and 9,000
Sunday's
feet in
trade.
the air, migrating in search of
I believe it was this Sunday.
Now you
can
know
see
what
we
ladybugs
gapped up.
would never do that.
We had a higher open, and where do we opened? Right into Friday's lower volatility window. Got to pull back down, filled the gap, and then sideways move. But this was Monday's pivots right here. And yesterday,
which really described the whole segment, which is
we had the market come down into the pivot.
What?
Find support, and then it opens at 69.
I needed that for sure.
So again, I like to look at
it's my son's 6th birthday.
The regular trading session hours, so I see the gaps based off of the previous close and open. So yesterday, we can see
Miss you too.
on Friday the market slid into
I'm just happy that you're
200 period average here, right?
Company of Mr. Saga and Jetty going forward.
Right here.
He's a superstar.
And it kind of bounced into the close. So Friday we closed at 63.75. Where did we open yesterday? We opened above Friday's close. We opened at 69.
Yeah, but thank you.
So by opening above Friday's close,
from the ground up, we managed to.
For me, that's a bullish open, and it tells me that it's leaving the shorts from Friday's session trapped below.
Got closer and closer every month over the course of the year.
If I open this up
despite the fact that politically she thinks
we had a gap yesterday right here, and we never filled that gap on the open. You see that?
You're just waiting to come out in favor of Bernie Sanders 2020.
What do we do is we open above the prior close, and it just continues higher into the end of the day.
It's been fun.
It has been fantastic.
Why does it do that? Is it's forcing the shorts to cover.
Next week on Rising.
We'll do some things.
We're looking. So if I see a higher open,
fabulous
so I know it's a bullish bias on a day, then I look on an intraday basis here, higher open, it's above the pivots, right? And then yesterday we rallied into the upper volatility window. You can see it took a couple of times before breaking through that. So the windows are very important because the market can rally into them and back away. But
at Farmers Insurance, we know a thing.
And again, that's why the time is important. So a couple of times it traded through the volatility. So just because it's trading through the vol window doesn't mean I'm buying it. I want to see if the market can sustain a move above that. If it can hold above for 5 minutes to establish the bullish bias, and then that tells me that the pressure is to the upside. So that's what we had yesterday. And so
depends.
So we rallied into the upper vol window, and you can see multiple attempts, 1, 2, and the sellers are trying to defend that. That's why you have the market failing to overcome that. They're defending that. You got pullbacks, but notice the pullback into the open is holding, right? The first 10 minutes.
Governor Janet Mills signed into law one of the nation's
so even though we rallied into that upper vol window, the pullback into the open was being defended. And finally, we bust through the volatility window, hold above that to establish the bullish bias. And what does that do is it lures buyers, it forces buyers to pay up above yesterday, the upper volatility window, which is 29.77. Leaves the shorts from Friday's session
to take that step after California passed its own strict privacy law
trapped
last year, setting
low,
off a flurry of industry lobbying and praise
we had a
from
gap up,
privacy
so all the shorts from Friday were trapped, opens higher, leaves the shorts trapped, breaks the upper volatility window, forces new buyers to step up and expand it higher, and the shorts are used as fuel to move the market higher. We made a high of 85, back to that famous 85 number. And then into the end of the day, what happens is, remember yesterday we had also a big sell into the close. The market traded down, and since it's a bullish bias, you know that the upper volatility window is your first level of support right there. And if it failed that, then the opening range would be the next support, and then the reversal window.
Seen it, covered it. At Farmers
But
Insurance,
notice
we know a thing
yesterday
or two
the
because
market
we've seen
held
a thing or two.
above its upper volatility window. By doing that, it kept
Nancy Pelosi for that
it left the shorts
comment.
on the wrong
Here's
side,
President Trump at a Fox News
trapped.
interview.
And we closed on the highs. The shorts were forced to cover into the close. But you know that you have a bullish bias on the day, so that volatility window is key to hold. And that can be an area that you look at buying the market into testing that. Today, we go to see what today's happening. And today is kind of very similar to what we've had pretty much the last couple of weeks. Is whenever the market opens strong, is the buyers lose it. Yesterday, the market opened strong, but we traded higher because there were shorts from Friday who were on the hook. Today, the market opened strong, and the buyers dropped ball. So they stopped out the shorts from Friday. And then today it sets up a higher open, lures in buyers on the open. You can see yesterday's close was 85. Today we opened at 86.75. So we opened above yesterday's close. Strong open, right? They're luring the late buyers who didn't come in yesterday. And runs, take out Friday's high, which was 93.
This app will
So
be
it
an
runs the stops
easy-to-use
above Friday's
app on the
high,
phone
and they drop the ball. It falls below 85, and let's look at on an intraday basis today. As you can see, we opened.
Students to have
This
their voices
yellow line is Friday's close or yesterday's close. We opened above that, squeezed through
where one student
the opening high into the upper volatility window, which for today was 95.
This will be an easy way
and
for
we made a
students
94
to
high,
tell us a tip,
so it
and it will go to a
fell
command
short,
center that
so it
is
rallied into the upper
100%
volatility window,
dedicated just for
found
North
resistance,
Carolina to
and
take in those
we
tips
fell
and
below.
prioritize them.
Again, news
and get them
related
to the right
ISM,
officials,
bad
whether it's
numbers.
at the school,
We fall below
whether it's
the
at
lower
law
volatility
enforcement for
window,
that local
established
area,
bearish
or
bias.
How will
Now
this be
what is done is
evaluated, or
all
who
the
will be in charge
buyers,
of evaluating
caught buyers
the
above
seriousness,
85
the veracity,
who are on the wrong side. And all the shorts who got stopped out yesterday are having to chase back in today.
Right?
And that's what's kind of putting this downside pressure today, is because the shorts got stopped out yesterday. New buyers were lured in, so new buyers are being squeezed out, and the shorts are being forced to chase the market down.
That's a great question, and we've actually been working on this for a year.
See, all the rallies today are failing. We have a strong bearish bias.
It's actually
in order to reverse today's bearish bias, we would have to close above or hold above the reversal window, which is 92 for 5 minutes. That's a very far, long way to go.
Mental health professionals,
and
as the tips
so
come
it doesn't look like that's going to be likely.
Urgent,
but any squeeze into the lower volatility window,
but if it comes in, it's urgent. There's a way to flag that and make sure
today's rallies are very minor.
As they come in, they are triaged.
We tested Friday's low was 40. So today we ran stops above Friday's high 93.
And then they're addressed.
Buyers drop the ball, falls below the vol window, establishes a bearish bias. So below this vol, if you're buying it, you're going against the momentum. And, there was a couple of buys, which gave opportunity for the market to rally, but it just couldn't turn. So even though the buys attempted to hold, the downside trend today is strong, and it continues expanding down.
At Farmers Insurance, we know a thing or two because we've seen a thing or two.
On the volatility windows for today,
This one?
if I'm looking at volatility windows on an intraday basis, I'm using it on a 10-minute chart. This gives me the picture for today. So the picture for today is the opening range. Squeeze into the upper vol window. The buyers run out of gas. They fail to overcome that upper vol window. And we got the rug pull below the lower volatility window, established the bearish bias, and now they smash into the downside. So covered this, and this was yesterday. Again, the bounce off of the volatility window, and the bias is bullish because it broke that upper window. So these are buyers being piling in above that volatility window. They're pushing it higher. As maybe a day trader or a short-term trader, or if you want to be more conservative or not chase into the highs, the pressure is up, so you want to buy weakness. So the weakness into that vol window is a level that you can defend. 3-day pivots is key, because that for me tells me what the momentum and trend is, and you can see when the pivots are blue, it means that the trend is technically higher, and when they're red, it means that we had a close. So I need to see 2 consecutive closes above the 3-day pivot to confirm a trend. And look at last week. So on the 20th, the market closed below the pivot for the first time since September 3rd. The next day, which was the 23rd, I think that was the Monday, even though it, overnight, you can see it failed to get past the pivots, flushed below. But then we closed right back. It rallied into the pivot, and it still closed below the pivot. So that was the second close below the pivot, and that confirms, for me, negative momentum, because the market failed to close over the pivot. And then on the 24th, which was Tuesday, is when you can see the overnight was above the pivot, but it failed to see buyers hold that, and that turned into a trap. We had 2 prior closes below the pivot, so that changed those pivots into a red, and the market fell below the pivots to continue that negative trend. The following day, the 25th, the pivot was above as resistance, so that the pressure is down, sellers are in control. You see the overnight fails, makes a new low,
also fix cars.
And then this was
covered it.
the
At Farmers
turn,
Insurance, we know a thing or
rallied
two
back
because we've seen a thing or
into
two.
the pivot, and we closed above. Again, we need 2 consecutive days to confirm a trend change. The next day,
Supreme Court on
Thursday,
Monday ruled that
same
an
thing
Obama-era
happened.
rule
We
change
got
on how
through the
Medicare
pivots,
reimbursements to
fell
hospitals
hold,
are
turns
made
into
should
another
be
bull
removed
trap. We
because
fall below
officials
the
did
pivot,
not follow the proper
and
notice
then you
and
can see the
comment
rally back
regulations
into the
in
pivot,
implementing
turns to
formula.
resistance.
The court
And
ruled
we settled
7-1
lower.
to vacate the rule, with Justice Neil Gorsuch
Friday,
writing the majority
same
opinion.
thing.
Justice
It got
Stephen
through the
Breyer was the
pivot,
sole dissenting
lures and
member of the
buyers
court,
above
and
that,
Justice Brett Kavanaugh was
and
not
we
involved in
fall
the case.
down to the pivot, below the pivot, rally,
even know
turn the
what you're
pivots into
doing?
resistance, and then we got the flush for
Do not worry, sir. I
getting
also
that
fix cars.
end of day squeeze.
Covered it.
Now, look at
Farmers
yesterday.
Insurance, we know a thing or two
Yesterday,
because
we
we've
were
seen a
actually
thing or
looking
two.
for a move through the pivot, and the reasoning was because of the higher open,
At Farmers
and
Insurance, we
because
know a thing or
of the
two
last
because
day of the
we've seen a
month,
thing or two.
and also
Rubber ducky?
because
You mean
right
this
here.
one?
Rubber ducky.
So overnight yesterday, you can see the sellers were defending the top of the pivot range, right? They were keeping the lid on price. They got the market to break, but they couldn't expand below the bottom of the pivot here. You see that? They couldn't expand it down. So that to me shows exhaustion on the sell side and opportunity to buy the market using that as my reference point, this low.
The
And
Supreme
we
Court
traded
on
through the
Monday
pivot,
found that a criminal
came
defendant
back
can
down,
be sentenced
turned
for
support, and we
violating his
closed above.
supervised release,
So yesterday
even
the
if
market
release
closed above the
expires
pivot.
while he is
Does that mean
incarcerated
that the
ahead of
trend
facing
and
new
momentum has
charges.
changed?
The justices divided
It does
in a
not,
5-4
because
decision
we
ruled
need
against
follow
the
through
Jason
today.
Mont's argument that a
And
district
what do we
court
have
shouldn't
today
be able to charge him for
is
violating his release
kind of what
because
we
the
had
term
all
had
of last
expired
week
at the
is
time of the new
the market was
sentencing.
above the
Justice
pivot,
Ruth
which
Bader
meant
Ginsburg
that it
sided with
was the moment for the
conservative
buyers
justices
to
Clarence Thomas,
hold
John
pullbacks
Roberts,
and to
Samuel Alito, and
follow
Brett
through
Kavanaugh
on
in the
yesterday's
majority.
turn.
Justice Neil Gorsuch
But look what
joined the
happens is
liberal
we
justices Sonia
resume, and
Sotomayor,
the
Stephen
the
Breyer,
sellers
and
liquidate
Ilana
into
Kagan
the.
in
Sometimes you'll
opposing the
close above the
decision.
pivot just to have buyers come in the next day, create bids to
At
sell
Farmers
into.
Insurance, we know a thing
And
or two
what
because we've seen
you
a
know
thing or two.
this can do
Even
is
us.
can keep you out of trouble. If
this
you're
one?
looking for a swing long, you need 2 consecutive closes above the 3-day pivot.
Again, Cookie?
Since today we fall below the pivot, then we're back into that negative trend, the negative momentum.
Depends. Did you
Because
cause
yesterday
the
we closed
accident?
above the pivot, today we lost it. So just because we closed above the pivot yesterday doesn't
Just
mean I'm
comes
going
with
to swing
experience.
long it. I need to see confirmation, and I need to see fall through today. If it's overall negative, then we'll see what will happen today is that it turns into a head fake.
Do not worry,
So
sir.
today
I
it looks
also
like we're
fix
going to
cars.
close below the pivot.
Seen it, covered it.
It
At Farmers
resumes the
Insurance, we
negative
know a thing
momentum
or
that
two
we've
because
had.
we've seen a thing or two.
Tomorrow's 3-day pivots will be above the market, which means the pressure will be down, and rallies into the pivots will be area to
The Supreme
defend
Court has
for the
declined to
sellers.
take up the case of an anti-Muslim group that sought to run ads
So,
depicting
how
the
much time
Prophet
do we have?
Muhammad on public transit in Washington, D.C. The justices, in an unsigned order issued Monday,
Let's
rejected
look
the
at
request from the
6
American
month
Freedom
volatility.
Defense
So we looked
Initiative
at
to hear
volatility
the
windows
case
on an
over the
intraday
ads,
basis,
which they
how it
asked to
sets
be
the tone for the
displayed
day
on
and
the
how it
D.C.
can
metro system.
catch people
The
off
Southern
sides to
Poverty
move
Law
it in the
Center has
opposite
labeled
direction,
AFDI
and
as
how
an
it can
anti-Muslim
also
hate
create
group.
trends
The ad
where it can
submitted by the
expand
group
above the
featured the
windows.
phrase
But
"support
we also
free
have this
speech"
on a
and then
6
an
month
image of
basis,
Muhammad, the
and
winning
the
picture
year
of
is
an art
divided into 2
contest
halves:
sponsored by
January
the
and
group.
June, January to June, and July to December.
At
And the
Farmers
first
Insurance,
2
we know a thing or
weeks
two because we've seen a thing or
of
two.
January
Even
is the
us.
opening range, and the
mean this
first
one?
2 weeks of July is the opening range. So if the first 2 weeks is an opening range,
Cookie?
what do we need to establish a bias? Half of that time, so
What about monsters
1
having
week.
accidents? I am
So
okay, by the way.
a bias is established for 5 daily closes above or below a volatility window,
How do you know
and a
all
reversal
this
bias
stuff?
is established
Just comes with
5 closes
experience.
above or below that reversal window. And let's take a look at a couple. So last year, remember we were coming
At
off in
Farmers Insurance, we've
2018
seen
last
almost
year.
everything, so we know
We
how to
had
cover
a
almost
strong
anything.
2017 after the election. Remember, 2017 was strong to the upside, right?
What does it look
Last
like,
year,
I am here to help you
in
with
January,
your
the market starts and it ramps up. The first 2 weeks, strong tone,
I
right?
also fix
And
cars.
once the 2 weeks are completed, it gave us this volatility window right here, which was 2,800.
And we covered it. At
But
Farmers,
the
we know a
buying
thing or
wasn't
two
done.
because we've seen a
The
thing or
market
two.
got through the upper volatility window. It closed above that 1, 2, 3, 4, 5. Establishes a bullish bias. Buyers are lured in above 2,800. And what happened is we had the rug pulled from underneath. And remember, this was coming off of 1 year. 2017 was bullish, up. So January of last year turned into a bull trap because it expanded up, got the late buyers in, and it fell below 2,800, trapping the late buyers, and then we broke the reversal window. 1, 2, 3, 4, 5, reversed the bullish bias. So everyone was caught on the wrong side on the year, trapped above 2,800, and you can see even though it was a reversal bias, we didn't expand to the downside. So we rallied back to the reversal window, or to the upper volatility window where the trap was set above 2,800. Holds as resistance, it leaves that supply trapped. We got to retest the low, and then it was walked up into the end of the first half, into June. So still closed below 2,800. Now the second half of last year, you can see we once again broke through the upper volatility window, established it was a bullish bias, and in this case we actually trended up. We overcame the January high, stopped out the shorts above that, and by holding above 2,800, it recovered the trapped buyers above that, and it gave way by any means, right? Test and overcome the January high. And you can see even though we trended up, took out the prior high here, falls into the reversal window here. And remember, since the 6-month bias is bullish, that reversal window is key for buyers to defend. So the first test that you see it was defended. We got to squeeze into the upper volatility window, which was again about 2,800, and the buyers failed to overcome that. And what does that do? Is it left buyers trapped from July, August, and September, and we had the market fall below its reversal window, reverses its bearish bullish bias, and again, no expansion to the downside. We had another test of that up 2,800, another test of 2,800 for the third time, and then finally it expanded down into the end of the year, liquidating the long side.
Prosecutors are supposed to give either charge or no charge. You're not supposed to editorialize
what I want to show you
about
is
someone if you're not bringing charges, but then kind of dirty
closed
them up
out the end of the year weak last year, right? We two times last year the market set bullish biases, and both of them turned into traps. So last year is really when the correction came, because it was establishing bullish biases, but it was only luring in late buyers. And it kept turning lower. There was more supply and demand above that 2,800. To begin this year, we had a V bottom. So I really, I'm a fan of V bottoms, because V bottoms, U-turns, whatever it is, because it shows this is where the market started its move down. It stops out the buyers or its liquidation, and it also lures in shorts. When it reverses the move, it has to take out the prior high. So this was the high that this leg started. Once that's recovered, that's a V bottom. So it stops out the buyers on the downside, stops out shorts on the upside. Now the market is shell-shocked. Everyone, they can't get it down. They couldn't get it up. They couldn't get it down. You create that V bottom, and when you create that V bottom, that's the opportunity to create a handle or a consolidation period. And again, what do we say the handle is? It's when it doesn't give the buyers a chance to buy the lows again, and it doesn't give shorts a chance to get out. So it kind of stabilizes and builds that handle. And the longer it holds, the more of a base it creates, and a breakthrough of that high gives room to expand this range up here. And that's what's considered a V bottom or a cup and handle. You see that here. Once we broke through that 25-20 level, we expanded up and completed the objective.
Great to be here. Thanks so much for having me.
And again, that objective is by taking this range and adding it to the top, and that gives you a target.
While you were also reporting,
but again, this is coming after December, where we closed December on the low. We started the new year in January this year. We had a V bottom, which gave potential to squeeze. Now let's look at January of this year, and that was, so this is your V bottom.
300 pages, and I just did the math, and I needed to give it in July.
This is your V bottom here.
7,000 words, 10,000 words a month.
This is your handle.
At 2,500 words a week, and just
chop
try to keep to that. And I found
and we got squeezed.
Because you can always write 500
this was
words in a day.
January's upper volatility window, which was
find a way to bang it out.
I do.
when coffee's involved, you can make it happen. But a lot of the reporting I had already done. A lot of the travel. I'd been to Ukraine. I'd been to U.S. Space Command. I'd been to the South China Sea.
28-22 right there.
So
and we broke through the upper volatility window. 1, 2, 3, 4, 5 daily closes above that.
And I was doing
established
with
bullish 6-month bias for January to June.
Officials, defense officials,
and also you have a bull flag.
Michael Hayden's, the Ash Carters of the world. As I was
initial
going,
move up, flags,
and oftentimes
as long as it holds above that vol window, buyers have control,
themselves
and
as these
take
stories
flag
were playing
out, opportunity to
their
expand
interviews
up to
just sort of naturally fit into the storyline.
This is what we had the last half of the year. As you can see, we broke through the upper volatility window.
Okay, so the premise is that both China and Russia,
you have a 6-month bullish bias,
but remarkably find a similar kind of strategy. Both China and Russia are fighting, in effect, an undeclared war on the U.S. on multiple fronts.
And then going into the second half of the year, what happened? We had a little bit of a correction down, held this low, right, in the March low, and then we closed the first half of the year right on the highs.
In Ukraine, manufacturing,
so the shorts fell to take out that March low. They were forced to cover into the first half of the year. Just like you're forced to cover into the close of the day, they're forced to cover into the first half. And then to where we are right now is
a couple hundred miles, a few thousand miles, depending on the orbit. Weapons
second half
to
of this year
disable or neutralize U.S. space assets
the market
that we
broke
and our military
below its 6-month volatility window, which was 29.26.
Satellites, drones don't fly.
1, 2, 3.
We don't have nuclear early warning.
Rallies into that volatility window, fails to overcome that. We have 5 daily closes below. What does that do? It's established a bearish bias.
Cyber attacks.
Sellers are being loaded below 29.26.
And the other front,
and then you can see all the rallies into that 29.26
too much about is that there's a battle under the seas right now.
Acting as a lid, we had a flush down from August 22nd with a high of 39.75, retesting the low of August, and then another V bottom. We reversed to cover that August 22nd high, creating a V.
Or cut your
and
talk about
that was also cup and handle or a V bottom. Start September where the market overcomes 29.26 and it left the shorts track below that, gave way for the retest of the highs. But the 6-month bearish bias, or the 6-month bias from July to December, it's still bearish. So even though we're rallying into testing the highs, the bias is still bearish. And in order to reverse that bearish bias,
what have we really done to punish Russia for invading Ukraine or China for, in effect, invading the South China Sea
in a little bit here.
For the 2016 hack.
Clearly not enough. In order to reverse the bearish bias, we need to hold above this,
which is the lessons learned. What might the U.S. do
at 30.35?
I did find one thing interesting where you thought you suggested almost that the U.S. should be interfering in Russia.
So last week on Friday, am I reading that the wrong way? All down to retest
very provocative suggestion.
Well, first of all, which was I polled half a dozen current and former officials,
bounced off
both
46,
and
then
European,
yesterday
former head
gap
of
up,
MI6, the
which held
sitting president of
Friday
Estonia,
low,
which has been on the front
trapped.
lines
So look how it keeps the shorts trapped for Friday.
The first nation-on-nation cyber attack.
Today we get a higher open, take out Friday's 93 high, run the stops above that, and the buyers failed to step up. They failed to capitalize on the gap up today.
John Podesta's emails, for instance, and dumping them 20 minutes after the Access Hollywood taped up. You know, that was
this is not the whole thing. Day traders pushing this down. This is funds liquidating into this higher open, and they're selling into these rallies.
I believe this is
and the 6-month bias is still bearish, unless we get through 30.35. So now, pull back into 29.26 is key for buyers to defend, to keep shorts from August traps below.
Do we worry that it might
so if you sold, sold below 29.26, when it got through, you got stuck below that, and you're taking heat. Back down to 29.26 is key because
there are other officials who make a counterpoint to that. There's debate about this on each of these steps. I believe it was Michael Hayden who said,
and I look at the low of September 28.89 key. If that's taken out, because that's where this initial move started, we take out 28.89, that confirms that this was a failed breakout, and it gives sellers another shot at these lows.
So on some of these measures, there is a debate.
You know that
for instance,
6-month bias
does the U.S. deploy space weapons like Russia and China to deter?
July to December is bearish.
There is a school of thought that yes, you do, because they're already
key
up
to
there,
hold
and you got to play by these new Wild West rules.
Down to that lower volatility window, 29.30. Again, you can see rallies.
And better to negotiate a treaty first.
Rallies are being sold, so the sellers are maintaining control. And if anything, look what's going on here is the V bottom, and the move up is fueled by shorts being squeezed.
The U.S. is so much more dependent.
And then it takes out the August high, which is 3,014.
Connectivity.
So it runs the stops above 3,014, and it lures in new buyers above that, but the buyers felt to hold, and it turns into another trap. And you can see ever since then, the buyers have having trouble getting past that 3014 level.
Particularly in China's case,
so we took out this low, the 29.57.
So they seek to
attempting to bounce, but failing to get past that 29.95. So today is the first trading day of the month. 29.93 was the high. That's going to be key now to recover,
not so much our weaknesses as our vulnerabilities,
reverse
and they seek to exploit
the break that we had today for another shot at 6-month reversal under at 30.35.
Telecommunications, all the things that we all depend on.
Take the range that we had from this V bottom from 30,
all of it is connected.
From 29.46 down to 28.10.
It is.
Add that to 29.46. That gives us an objective of 38.82. So as long as we hold above 29.26, the market has room to expand to 30.80. But it's going to have to hold this to keep shorts trapped below that and not give them an opportunity. It's like not give sellers another chance to try to expand.
Not quite Civil War, but World War II
stuck below that,
here.
so back up to that.
Let me find my sextant.
Gives them a chance to take control or
absolutely, because they said there might come a day when the GPS
or stay trapped.
Exactly. So that's in the military realm, and then in the civilian realm. I mean, they're the ways we know. For instance,
another cup and handle
technology. I mean,
reversal where you have this was in gold,
GPS.
But where we had a high of 1350 down to 1161 and created a V bottom.
You take out GPS
U-turn,
to disable it.
And you can see a little bit of a pullback consolidation.
Railroad
back through
switches
1350 is confirmation.
So you could
the cup and
paralyze
handle,
or significantly undermine railroad
upside,
traffic.
And that 1520
was
where the market fell.
So they know that in the event of a war, something short of a war,
when the Fed came out with
they could make us pay a heavy
unemployment
price.
target.
One of the things
the
we talk about
rate
in the book is about the specialty of Russian disinformation. So now the
gold farm at that. When the Feds,
do you think that there's a chance,
when the unemployment rate got to 6.5%, the Feds didn't start hiking.
Was Russian
they left interest rate zero,
so much of it,
and that's when gold started stabilizing.
Either proved
to be untrue, sideways for multiple years,
Miami,
and this year,
no Russian consulate,
when the Fed start, instead of hiking, they're actually cutting.
That might be Russian
disinformation?
It's possible, or portions of it, right? I mean, remember, what was the dossier but a collection of
I like these patterns because it shows that the market broke and it recovered its break.
Of course, initially repeatedly denied.
And it can be done inverted too. Once the break is recovered, it shows a failed breakdown.
The question is,
and a reversal,
what was the substance of those
and I use that range to give me
was it
an
just
upside
establishing
objective.
contacts, or were they discussing something more?
So
I think you have to look at the dossier as what it was,
which
was kind of a raw tip sheet in a way, but it's certainly possible that some of those sources were feeding disinformation.
The most incendiary claims, like the Prague meeting, that didn't happen.
Absolutely.
The P-tape, we're still not quite sure about that.
If you want to, the Top Step is offering 1 week free trial of the volatility windows.
The last 2 years was focused on litigating.
So you can try it out for the week.
It seems that they might have succeeded beyond
their wildest
dreams.
Well, plug in the volatility windows into your 10-minute time frame so you can see how the market reacts to them. And over time, you can gain flow of how the market trades around them.
Divisions that already exist here.
So I think Marlon will probably post a link where you guys can sign up for that free trial.
But on a whole host of other controversial issues.
And to get more technical as far as actual specific entry points and exits,
protests in the NFL.
We have a proprietary system called Hollow where it identifies like all breakdowns
was behind some of these bots that were getting heavy into
levels
the NFL
that we
protests
can defend
because
based off
the hashtag was take a knee. The Russian bots have screwed up the translation on some of this, and they put the hashtag take the knee because it's hard to get those particles, those articles of speech right, and that was one way you knew. So part of the motivation is just mess with us, right? And they do that really well. But there was also a motivation to disable the candidacy and help the candidacy.
Right. So I'm this is something that preoccupies me a lot.
And
because
thank you for
last
your time.
week,
Have a great day.
10 days ago, we saw the Urban League come out with their State of Black America
follow
report, where
at
they
Chicagostock
talk
on
about
Twitter.
the Russian attempt to manipulate race and to go after many of the African-American activists that were out there.
Okay. Well, thank you very much, Stuart. Great presentation.
Because they feel personally
I finally figured out the audio you guys told me. But next up, we've got Kashul from Volatility Box. Very smart guy. Great stuff. He's been in our forum now for about a month and a half.